Hey, welcome back. I'm Alex Morgan, and if you have been following the stock market this week, you already know things have been absolutely wild. But here is the thing. Most people are only seeing the surface. They see the numbers move, they hear words like tariffs and Supreme Court, and they just nod along without truly understanding what just happened, why it happened, and most critically, what it means for your money going forward. So today, we are going to change that. We are going to pull back the curtain on one of the most significant legal and financial events of 2026, a ruling that shook Wall Street, triggered a presidential meltdown, and set off a chain of events that is still unfolding as you watch this video right now. Stay with me because by the end of this, you will understand this market moment better than 99% of investors out there, and you will know exactly which direction the stock market could move next. Let's start at the very beginning, because context is everything. When President Donald Trump entered his second term in the White House, tariffs became the centerpiece of his entire economic philosophy. The idea was straightforward on the surface. Tax foreign goods coming into the United States, use that revenue to fund domestic priorities, and pressure trade partners into better deals for American workers and companies. To enforce this vision, Trump leaned heavily on a piece of legislation known as the International Emergency Economic Powers Act, or IEEPA, a law originally designed to give presidents emergency powers during national security crises. Trump's legal team argued that America's massive trade deficit constituted just such an emergency, and that IEEPA gave the president the sweeping authority to impose tariffs on virtually any country he chose, and impose them he did. On what became known as Liberation Day, Trump unveiled a sweeping package of so-called reciprocal tariffs targeting dozens of countries across the globe. The tariffs were aggressive, broad, and almost immediately controversial. Businesses scrambled to figure out what they meant. Supply chains were rerouted. Inflation crept back into the economic conversation. The Federal Reserve found itself in an uncomfortable position, watching prices tick upward, even as the broader economy was slowing. And investors, always watching for certainty, found themselves navigating a fog that seemed to grow thicker with every White House press briefing. But even as businesses grudgingly adapted to this new reality, a legal challenge was quietly working its way through the courts. In May 2025, a panel of judges at the United States Court of International Trade ruled unanimously that the IEEPA tariffs were illegal. The Trump administration appealed, and that ruling was upheld by the Court of Appeals in August 2025. The tariffs remained in place, while the government prepared its case for the highest court in the land. On November 5, 2025, the Supreme Court heard oral arguments. And then on February 20, 2026, just 5 days ago, the Supreme Court of the United States delivered its verdict. In a 6-3 decision in Learning Resources Inc. vs. Trump and VOS Selections vs. United States, the court ruled that IEEPA does not authorize the president to impose tariffs. Chief Justice John Roberts was joined by Justices Sotomayor, Kagan, Gorsuch, Barrett, and Jackson, while Justices Thomas Kavanaugh and Alito dissented. It was a bipartisan rebuke of presidential overreach, a rare moment where conservative and liberal justices stood together to draw a clear constitutional line. The message from the court was unambiguous. No matter how you frame it, using emergency powers to impose sweeping economic tariffs on the entire world is not within the bounds of the law. The financial implications were staggering. The Tax Foundation estimates those tariffs had already raised more than $160 billion for the federal government through February 20, 2026, and would have raised $1.4 trillion from 2026 through 2035. The ruling effectively erased nearly 3/4 of the new tax revenue the Trump administration had hoped to raise from tariffs. Think about that number for a moment. $1.4 trillion in projected revenue, gone with the stroke of a judicial pen. This was not a minor policy tweak. This was a seismic shift in the American economic landscape. Now, how did Wall Street react? Stocks rose on Friday after the ruling, with the S&P 500 advancing 0.69% to close at 6909.51. The Nasdaq Composite gaining 0.9% to settle at 22,886.07, and the Dow Jones Industrial Average adding 230.81 points, or 0.47%, to end at 49,625.97. Those sound like solid gains, and they were, but the market's reaction was actually more nuanced and more interesting than the headline numbers suggest. Treasury bonds and a Bloomberg gauge of the dollar fell, while stocks rallied after the court struck down Trump's sweeping global tariffs. This is a classic relief rally pattern. When a major source of uncertainty is removed from the market, money flows back into equities and out of safe haven assets like bonds and the dollar. Investors who had been sitting on cash, waiting to see which way the tariff saga would resolve, felt a window of clarity open, and they moved through it quickly. But here is where it gets really interesting, because the market did not just go straight up. The Dow Jones recovered from a 200-point loss earlier in the session on disappointing economic data. So even on the day of a major legal victory for free trade, the market had to wrestle with a sobering economic report showing that the U.S. economy grew at just 1.4% annualized in the fourth quarter, well below expectations. The market wanted to celebrate, but reality kept tapping it on the shoulder. Dan Ives of Wedbush Securities captured the mood well. He wrote that the ruling was a clear blow to the Trump tariff policy, and that while it was a turning moment for the Trump administration's tariff agenda, there will be other ways the administration can leverage to keep these tariff deals made with other countries in place. That last part was the critical caveat that every smart investor was paying attention to. The Supreme Court had not eliminated tariffs from the American economic equation. It had simply removed one legal vehicle for imposing them, and that caveat became reality within hours. President Donald Trump signed an executive order late Friday imposing a new 10% global tariff under Section 122 of the Trade Act of 1974, hours after the Supreme Court struck down his sweeping reciprocal import duties. On Saturday, Trump raised that to 15%, effective immediately. Then on Monday, Trump addressed the nation at the State of the Union, where he condemned what he called the Supreme Court's unfortunate involvement, while 4 justices sat motionless a few feet away. It was an extraordinary moment. A sitting president publicly attacking the judiciary on national television, vowing to press on with his trade agenda by any legal means necessary. The market's reaction to this presidential defiance was swift and harsh. On Monday, February 23rd, the Dow Jones Industrial Average dropped 821.91 points, or 1.66%, to close at 48,804. The Nasdaq Composite declined 1.13% to end at 22,627. The S&P 500 shed 1.04%, putting it back into the red for 2026. The Friday euphoria had evaporated in a single session. Investors who had celebrated the Supreme Court's ruling on Thursday night were now staring at red across their portfolios on Monday morning. What happened? 2 forces hit simultaneously. First, the realization that tariffs were not going away. They were simply being restructured under new legal authority. AI disruption fears also collided with the tariff news, as IBM shares declined 13% after Anthropic outlined new programming capabilities for its Claude Code product. Software stocks like Microsoft and CrowdStrike were under pressure as AI disruption worries hovered over the market. So on the same week the Supreme Court was making history on trade policy, artificial intelligence was quietly threatening to disrupt entire industries, and the stock market had to process both storylines at once. That is the world we are living in right now. not one macro risk, but several, happening simultaneously, feeding off each other, creating a volatility environment that even experienced investors are finding difficult to navigate. Now let's zoom out and ask the bigger question that every viewer of this channel really wants answered. Where does the stock market go from here? To answer that honestly, we need to understand what is still unresolved. The Trump administration is launching new national security investigations to try to justify additional global tariffs, and the European Union has already warned that Trump's shifting tariff priorities likely violate the US-EU trade agreement. EU lawmakers delayed ratification of the deal, saying they need full clarity on Trump's next steps. Meanwhile, FedEx has already filed suit against the U.S. government seeking a full refund on tariffs it paid under IEEPA, and it is almost certainly the first of thousands of companies that will do the same. Raymond James policy analyst Ed Mills warned that the process for firms to receive tariff refunds will be lengthy and challenging, with litigants needing to bring individual cases or participate in class actions rather than receiving automatic refunds. This means years of legal uncertainty and corporate distraction. Companies that budgeted for tariff costs will now need to decide how aggressively to pursue refunds, how to model future tariff risk, and whether to continue the supply chain restructuring they began in 2025. On the monetary policy side, the picture is equally complex. Market expectations for Federal Reserve rate cuts in 2026 took a significant drop this week. The probability of a 25 basis point cut in March moved down to just 5%, April eased to 18%, while June currently stands at 57%. The Fed is watching all of this very carefully. If the removal of IEEPA tariffs leads to lower import prices and easing inflation, the Fed will have more room to cut rates, which would be a major tailwind for stocks. But if Trump's new 15% Section 122 tariffs keep inflation elevated, the Fed may stay on hold longer than markets want. Federal Reserve Bank of Chicago President Austin Goolsbee recently said that if the path toward 2% inflation continues, I still think there are several more rate cuts that can happen in 2026. That is an encouraging signal, but it is conditional. Everything hinges on whether the new, lower authority tariffs cause a meaningful inflationary resurgence, or whether they are modest enough to allow price pressures to continue cooling. Fed Governor Christopher Waller acknowledged that the Supreme Court ruling overturning a large share of import tariffs may have a positive impact on spending and investment, but noted that how large that impact may be and how long it could last is unclear. Even the Fed's own governors are being careful not to overstate the ruling's positive economic effects. That measured tone tells you a lot about the genuine uncertainty that still hangs over this market. So, which direction could the stock market move from here? Let's lay out the two most credible scenarios. In the bullish scenario, the 15% global tariff under Section 122 proves less economically damaging than the original IEEPA tariffs because it is set to expire in 150 days and covers fewer product categories. Inflation continues its gradual decline toward the Fed's 2% target. The Fed, freed from tariff-related inflation fears, begins cutting rates in June, boosting corporate earnings expectations and consumer spending. NVIDIA's earnings, which report tonight, February 25th, come in strong and confirm that AI infrastructure spending remains robust. The Magnificent Seven stocks, beaten down to start 2026, begin a recovery. The S&P 500 breaks back above 7,000 and challenges all-time highs by summer. This scenario is supported by the strong corporate earnings we have already seen this season, the resilience of consumer spending among higher-income households, and the fiscal stimulus baked in by last year's One Big Beautiful Bill Act. In the bearish scenario, Trump escalates beyond 15%, possibly to 25% or beyond, either by finding new legal authorities or by pressuring Congress to grant him expanded trade powers. The EU and other trading partners retaliate, triggering a genuine trade war that squeezes corporate margins. The Fed, caught between slowing growth and persistent inflation, is paralyzed, unable to cut rates without risking an inflation resurgence, unable to raise them without pushing the economy toward recession. Gabelli Fund's portfolio manager, Justin Bergner, already defensively positioned in consumer staples, healthcare, and utility stocks, warned that at some point something could give and flagged the possibility of a 10% to 15% market pullback. In this scenario, the S&P 500 could test the 6,400 to 6,500 range, a correction territory that would wipe out all of 2025's gains. The honest answer is that both scenarios are live right now. As Dominic Pappalardo, chief multi-asset strategist for Morningstar Wealth, explained, a year of policy volatility had made projections, budgeting, and investment plans quite difficult for businesses, and the ruling offers a degree of clarity. But Trump's rapid pivot to new tariff mechanisms means that clarity may be shorter-lived than markets initially hoped. What should you be watching in the days and weeks ahead? 4 things. First, NVIDIA's earnings tonight. They are the single most important data point for the AI investment narrative, and a miss or weak guidance could trigger another wave of tech selling. Second, the February jobs report, coming March 6th, which the Fed has explicitly said it needs before making any rate decisions. Third, any new tariff announcements from the White House, particularly whether the 15% Section 122 tariff gets challenged in court, which analysts at TD Cowen say is likely given that it may not meet the legal threshold for a balance of payments crisis that Section 122 requires. And fourth, the EU's next move. Because if the world's largest trading bloc formally retaliates against American tariffs, the global growth picture changes dramatically and quickly. Here is the bottom line. The Supreme Court's ruling against Trump's IEEPA tariffs was genuinely significant. It was a constitutional check on executive power, a potential inflation relief valve, and a signal that the rule of law still functions as a guardrail on economic policy in America. The market celebrated, briefly. Then reality arrived in the form of a president who moved immediately to reconstitute his trade agenda through alternative legal channels, a new 15% global tariff that is already drawing legal scrutiny, and a Wall Street that is now asking whether the fight over tariffs is truly over or simply entering a new and potentially more chaotic phase. As Orion Wealth Management's chief investment officer Tim Holland put it would seem that Wall Street and Main Street are going to be dealing with the issue of trade and tariffs for some time to come. That is perhaps the most honest and important sentence that was written about markets this entire week. Tariffs are not resolved, they are reorganized. And in a market that craves certainty above all else, reorganized uncertainty is still uncertainty. The smart money right now is not betting all in on a bull run or panic selling into a bear case. It is diversifying thoughtfully, watching the data closely, keeping some dry powder available for the volatility that is almost certainly still coming, and paying very close attention to the legal battles that will determine just how much tariff authority the Trump administration can actually wield in the months ahead. I am Alex Morgan, and this is the stock market story that matters most right now. If this breakdown gave you genuine value and helped you understand something that mainstream headlines glossed over, hit that like button, share this with someone who needs to hear it, and subscribe so you never miss an analysis like this one. The market is moving fast in 2026. And the one thing you cannot afford to do is fall behind. Stay sharp, stay informed, and I will see you in the next one.